Okay, so we're doing the function currencies versus pounds. We're using the current rate method. And the current rate method is a little bit easier because it uses the current rate for a lot of stuff. Okay, income statement stuff. The general rule is that it's an average throughout the year. You make sales and throughout the year, and that there'll be an average rate. And so the average rate is 128. And the cost of goods sold where's my methods? Here's my methods. F19. Can't use that one actually. Not the right one. Here we go. Sorry. It's fun watching me learn how to use a computer. That's what you guys pay money for. Some bumbling idiot learn how to use a computer. Okay. So coming down here for the income statement stuff, everything pretty much goes in at the average. And this is because they are not bringing this back into US dollars. They're leaving it in the foreign currency. And so all of these are going to be now the gain on sale of land, this will be on 6/22, so that is at a specific point in time. So we will use that. Uh, 86,680, is that what you guys got?
Yep.
Yeah. And that'll come down here. Now, beginning retained earnings. Now, this, if it's a if it's going year to year, they'll usually just give that to you because this can be a composite. But since they bought this on the first of the year, we're just going to use the historical for the first of the year here. Dividends, we're on 10/31, so this is when dividends are paid. Okay, so I think. Let's try a different color. You get ending retained earnings of 460.40. And by the way, for those, they tell you that it's going to be a composite, and this is why, because it goes in at all different rates. The income's at different rates, dividends are at different rates, or they can be anyways. So they tell you it's a composite. Did you guys get that though? 460.40.
Yeah.
Yeah, that's what I got.
Okay. All right. Balance sheet, and this is where things really change between the two methods, and that the balance sheet, everything goes in at the current rate, at the year-end rate. Remember that these things were not translated into US dollars. So, if you're wondering why that is, it's because they weren't translated into US dollars at the end of the, whenever the transactions were made. So they're still in the foreign currency. So that will be the current rate, the ending rate. So in other words, this 88,000, what are these pounds? 88,000 pounds would translate at year end to $1.35. That's why we get this dollars over here. That would be what it would translate at that time. Yeah, let's make that blue. Okay. Accounts payable, same thing, end of the year. Accounts payable, same thing. Common stock, that will be on the first of the year. That'll be historic. Oops. And retained earnings will be our retained earnings from up here. Okay, so translation gain or loss would be that minus that. Nope, that. 12,080, and would that be a gain or loss?
That's a gain?
Yeah, this would be a gain because it's sort of like this. Whatever they are, they have assets worth $1,047,000, but they really only owe other people the common stock and the liabilities. They really only owe $1,035,000. So yeah, it's a gain. Any question on that thing? So I think that finishes that handout, right? Let me. Problem. Yeah. Okay. Well, the gains are pretty similar for these two. 1280 versus well, up by $40. Incomes were off by a little bit more, 6,000, 7 almost, more than 7. Yeah. And again, so this is what, so if you're doing a consolidation, these are the consolidating numbers for what you would have. These would be what you'd consolidate with, with whatever other operations you have, along with the your US operations. You consolidate, these totals. And this gain would be picked up as comprehensive income. This would be comprehensive income. This one would be in net income. This would be a plain old gain. I'll tell you something that you'd get from a tricky CPA question. They might ask you, how would the translation for this foreign currency using the current rate, how would it impact your income? You're tempted to say by 12,000, whatever. Actually, it's zero. It doesn't have any impact on your income. It only impacts the comprehensive income, which is separate from regular income. Okay, so I think I put that to turn in on the 25th, I believe. On the 25th, I'm going to save this just in case I do something stupid. Not that I ever have, but Okay, I sent out another one. This is a problem out of the textbook, and the textbook problem is problem 33 in chapter 10. This is an ebook. I'm not sure if they even have pages here. Oh, they do. Page 588. So if you're using the book, it's on page 526. No, that's wrong. 527. So this is on page, no, not that one. So this is in your textbook on page 5. So if you're using a textbook, page 527. Now I put it into Excel just because I think it's a little easier to do it that way. And I'm changing it a little bit from the way the book shows it because I want to do it both the current method and the temporal method. The book only shows the current method. You guys can't see a thing I'm doing, can you? I am so sorry. You should have like a way to throw a shoe at somebody when they're using Zoom. Then with the shoe, hey, we can't see your screen. I'm sorry. So this is in yeah. So this is problem 1033. It's on page 527 in the textbook. It looks like this, which of course you couldn't see because I knucklehead. And so this is what we're going to be doing. Yeah, again, I just take it from this and put it into a spreadsheet just because it's just easier to do it this way. So what we're going to do is kind of see how we're going to work this out. Now, there is this problem is actually is if it went from one year to the next. And so they're going to give us the retained earnings translation, because the only way to get that, if they give it to us, would be to go through, you know, however many years of translation they have. So that translation number is going to be given to us, and we're just going to plug that in. We don't have to look for a rate for the beginning retained earnings, because it's going to be just whatever they came up with. And most of the rest of the stuff is pretty much the same. The only thing you have to keep in mind, though, too, is that the gains and losses are, well, I'll get when we get to that. Okay. So, weird spacing here. Get this closer to, I guess okay. So here to give us some of the exchange rates up here. Common stock, pipeline equipment, blah, blah, blah. And they give us some more exchange rates down here. I think I use this one to do my handouts. I think this is the one that I kind of use the format of it. So the first thing we're going to do is do the currency rate method. So we're going to use this method first, and then we'll go on to the other one. And let's do something with that. How about make it yellow? Okay. All right. So income statement. Pretty much everything goes in at the average rate. So the average weight for 2020 is $1.59. And that'll be the same for that one. Operating expenses without depreciation will be the same. And depreciation will be the same for this method. Gain on sale of equipment. What's the date on that? Oh, here, equipment sold. Let's highlight that. Equipment was sold on September 1st. So 170, so okay, well, equipment sold. Okay. And it was a gain. I just did something stupid. Let's try that again. There we go. Okay, any question on that thing? Okay, so this is get this color. Oh no, it's not that color. Okay. Now this is where it gets a little bit tricky down here for the retained earnings, because the beginning retained earnings retained earnings is translated at that. So we're just going to take this and put it down here. And again, that's because it's from the previous years. And so we started, if you didn't just keep that as a running total, you'd have to go back and calculate for 25 years of owning the subsidiary or whatever. Okay, so this is a given number in this one. All right, income we already have. Dividends. Dividends declared on April 1st. Like that. Orange, or whatever that thing is. Okay. Coming down here, now this is the current rate method, so this method is a little bit easier. What's the current rate at year end?
$154.
Yep, this is gonna be the current rate at year end. Then there's a turquoise color here. That's weird on this palette is they don't have anything in the reds. I mean, they have orange, but you know, it's seems to be a glaring omission to me. Okay, so yeah, so the current rate is going to be 154. Copy the one. So our total assets will be 857,780. Oops. And again, that's just you know, yeah, you can guess why they call it the current rate method. Pretty much everything goes in at current rate on the balance sheet. And the liabilities, they just kind of lumped them all together. That's fine. Yeah, so the common stock, they told us up here. I don't know why they got it separate up here, but well, I guess it's because you don't know how far back it goes. But the exchange rate for when common stock was issued was 208. Oops. And again, sometimes, you know, these can go back 40 years. I mean, they're, you know, it's. Can we see that? It's not much better. Oh, well, we'll leave it. Okay, so the exchange rate when the common stock was issued was 208. So we'll use that. Retained earnings is just what there's in the retained earnings, which is here. Pull that. Okay, so this is the assets we have. This is what we owe. So the difference is 131,710. Is that going to be a gain or loss?
That's a lot. Right?
Would that be a loss?
Yeah, it is a loss. It's a loss because we only have 857 of assets and we owe basically 989,000 of liabilities and equity. So this is going to be a loss. So this will be a translation. Okay, now They do tell us something up here, though. Oops. Oh, translation adjustment debit. A debit means is like for expense, it'll be a loss. So the loss in 2019 was 85,000. Now, the reason why that's, we're gonna need that down here, is that the, it's 85,000. The reason why we need that down here is that for this year, here's the weird thing about comprehensive income. Unlike normal income, it doesn't get cleared off the books. It just kind of sits there. And so the translation loss that we would add on for this year will be the difference between those two. Ooh, that's not it. 2020, sorry. So if 85,000 came from last year, would I have to add these? No. Let's try that again. So the translation loss that would have come from this year would have been 46,710. And again, here's the weird thing about it is that translation loss of 2017 is still sitting on the books. Unlike regular income that gets wiped out, usually like for your income statement, everything gets wiped out when you're when you start a new year. You have your revenues and expenses for 2019. Going to 2020, they set those all back to zero. And you start out 0, 0, 0. For everything, so it just gets wiped out. Well, for comprehensive income, gains and losses sit on the books. They sit in the equity, in the equity section. It's sort of like a second income statement that has a few more things on it. So, this would be the actual adjustment that they would book for this year, because this would already be on there. The 2019 would still be there from the previous year. So comprehensive income. I really thought comprehensive income was going to go away a few years ago, because for a while, the United States was the only country that used it. And so I thought, well, they're going to get rid of it. They're going to get rid of it. And now the actual international standards now use it too. So far from getting rid of it, it's now in the international standards also. Okay. So this is the one that they'd have for the book. This is what the book has, the current rate method. But I'd like to just do it for the temporal method too, just to, it's good to see both methods. And quite honestly, on the CPA exam, you never know what you're going to get. So doing it the other way will not hurt us. Now, there are some things that are going to come into play here. And one of the big ones is the inventory averages. Those are ones that are going to come into play. Because if you look at the temporal method, I'm missing a bunch of stuff here.
Just highlight between 41 and 61 and right click on hide.
Unhide.
Yeah.
Okay, sorry about. Thank you. I don't know what I was doing here. We don't need that. Is it? That's not the same over here, is it? It's not, that would be not paying attention. Okay, so everybody, yeah, so highlight the area and then click, right click and say unhide. Thank you very much for that. And it should unhide.
Quick question, on the text 10-33 current,
Mhm.
there was a $2 exchange rate. We didn't use that, right? On the prior one?
We didn't use it on that one, but we will use it on this one.
Okay.
Because this will be for the property, plant and equipment. Yeah, and now that we have both of them here, you'll see, where's property, plant and equipment? You'll see here that the, there's a difference here. So they do the historical cost for the property, plant and equipment, whereas for the current rate method, it was the current one. So we will be using that one for this. Now, for the book problem, for that one, you didn't need to use that. They just gave that to trick you, irritate you. But we will be using it for this one. Okay. Sales, these are gonna go in at, well, let's look down here. This is, just down here, if you look at it. So revenues, most expenses going at average, cost of goods sold will be historical, and that's be for the goods, the inventory, and depreciation will be at historical. So we have to pay a little bit more attention now. For the temporal method is a little bit more involved. Okay, so we'll use a weighted average for the sales. Cost of goods sold, we are going to use the historical average. So the historical average, whatever they bought, is actually 157. And if you're wondering why those might be different, they may very well be different because inventory, you have inventory from a previous year, whatever that inventory was purchased at would be at that exchange rate. So you may have an overlapping of, it could go actually beyond just 2020. There could be inventory in there from 2019 or even earlier. But that's why if you're wondering, you say, well, wait a minute, isn't the average just the average? It really depends on how much inventory they carried from one year to the next, or it can, I should say. Okay.
Just a quick question, is the same question, but we're using different method for it, right?
One more time.
Is it the same question, but we're using different method for it?
Exactly.
Is that right?
Yeah.
Okay.
Exactly. Yeah. Everything else is, everything here is the same as the previous one, with the exception of the method that we're using. And this temporal method, this is when they translate everything. They're taking the money, the foreign currency, and immediately transferring it into US dollars. It's when the dollars are physically are actually transferred into US dollars and brought back into the US basically. It's it's an integral part of our operations. So the current method is, hey, they're operating in that country, whatever country it is, and we're leaving the money in there. We're letting them up, autonomously, whatever. The temporal method is a little different. That's when it's immediately translated into US dollars. It could come about from a number of reasons. It could be the US company needs the dollars to, to operate. Sometimes companies are not doing well at home, but they're doing, bonkers someplace else, and so they transfer money in. It could also be that it's a country that has high inflation. If they have high inflation or an unstable currency, you take the money and as quickly as you can, you translate it into US dollars just because it's a more stable currency. So the temporal method is when you're actually folding it into your operations. more completely. Okay, operating expenses without depreciation will just be at the average cost. Depreciation expenses. Now this is where this comes into. We're depreciating this property, plant, and equipment. Make it blue. So this equipment that we're depreciating, we bought, when they bought this equipment, the translation rate was $2. So that's what we're going to use here. Hey, how come you're not centered? Okay, so this depreciation expense, this is based on the property, plant, and equipment. And so we have to know what the exchange rate was when we bought the property, plant, and equipment, and then we can figure out how that translates into dollars. Gain on sale of equipment. Same as before. We'll make it gray. September 1st. Nope, almost doing the same mistake again. Here we go. Let's make that yellow. Retained earnings, again, we have to use what they gave us. That number. Net income, we already calculated. Dividends, we're at the same time. It can't be right.
That's wrong.
It is wrong. Oh, I know what I did. I did something. I know it. I did something stupid here. There we go. Okay. So this would be our retained earnings. Okay, so cash and receivables are going to be at the current rate. We're gonna use the inventory at the historical average just because they told us it's, you know, it was average throughout the year, so this is the average, we'll use that. But the cash and receivables, and if you think about it, you know, when the best estimate of what these are gonna be collected at would be the current rate, which is what?
So December 31,
Yep.
155.
On the test, the biggest confusion is between the average rate and the current rate. The average rate is generally for the income statement. The current rate, in other words, the last day of the year, would be for the balance sheet. Okay. So 144, and it'd be the same thing for receivables. Oops. All right. Let's try that a third time. How about? Okay, inventory is going to be at the historical rate of 157. Didn't show that. Yeah, that's it. Okay. Property, plant, and equipment is going to be at what rate? Anyone? What's rate? We actually talked about it a little earlier.
So 157 too?
It's going to be the $2.
Oh, that's right.
It is weird. Here's the thing about the historical rates is that there's going to be a lot of times there's historical rates for many different things. You know, that there isn't just one historical rate, which is confusing, but okay, so this would be our total assets. Let's make it blue. No. It's blue. Oranger. Oranger, that's what we're gonna make it. Oranger. Liabilities going at the current rate, we're gonna have to pay them off, and the best estimate of what that is worth is common stock. That was a historical rate up here somewhere. $208. Oops. Do that. So exchange rate found when account was issued was 208. So we'll put that down here. Oh. That again. Retained earnings is the same as before, as with this up here. Okay, find the difference. Would that be a gain or loss?
It's a game.
Yep. And this would be part of the regular income. So this would be a gain on the income statement. And it would be a regular gain. Because everything is translated into US dollars, so this is. So it is what it is. It's just being in US dollars, that would be the gain. And any, and in this case, the translation loss of 80,000, whatever it was, 85,000 last year. That would have been in with the income, and when they close out the income, that would have been closed out also. So this would have been closed in. This 85,000 would have been closed in 2019. So, it's gone. And we have a new one. This one we have a gain. Question on that thing? I think I'm just gonna send out, it'll be kind of similar to the handouts. I'm gonna send out a problem that it'll be the same numbers, doing it two different ways, doing the current rate method and the temporal method. I'm just gonna send that out and that'll be the test. That's all right with you guys.
Do you mind pulling that problem back up? Sorry,
I certainly will.
I wanted to grab one more thing. Thank you.
Yeah,
Yeah, the bottom of the translation.
Yeah, so I'll just send that out. It'll go out tonight. I'm gonna because of my formatting problems, I want to check and make sure that it looks right. But I'm just gonna send it out tonight, and it'll be due. It'll be due on the. Oops. Oh, okay. So this will be all these will be due on the same date. So this is a chapter 10 handout. And let me check that time just to make sure. Friday the 25th, yeah. So I'll put these in the Blackboard, and this will be sent out. I'm going to try to get this out later tonight. I shouldn't have a problem with that, but it's possible it'll go into tomorrow, but I doubt it. All right, any questions? And again, the kind of the reason for the having the, it kind of seems like they're completely different things, the currency exchange versus what we do with the consolidations, but a lot of times the subsidiaries are consolidated into, they have consolidated financial statements. And so, they have to bring in those dollars. If they're consolidating with US dollars, they have to come with US dollars. So for instance, on this one, this would be the consolidation amounts. This is what they would consolidate with the US companies. These would be the dollar amounts for the subsidiary. Question on that? We are an hour early. So I want you guys to put your head down it's on the honor system. Put your head down for the next hour, and when that's up, then you can go play. No, so anyway, so I'll send out the exams shortly. They should be out within the next hour. If they're not, they should be. That's the plan. So you should be getting them in the next hour. And again, everything is going to be due on the 25th. Any questions? All right, well, go enjoy the night. It's beautiful out, and I will see you guys in a week's time.
Thank you.
Thanks, guys.
Thank you.